Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. 4 weeks ago, the market broke above the highlighted in purple late July to late August bearish shift pitch walk. The reason I say broke rather than breached at the time was that 3 weeks ago we also had a weekly key reversal up. And if you're going to break a pattern such as the bearish shift pitch walk, then there is no better tool than a weekly key reversal up, apart from perhaps a monthly key reversal up. 3 weeks ago, the market approached its first real test overhead. That was the flatlining short medium moving average, currently 1331, highlighted in green on my daily chart. This was not that heavy a resistance, though it did a good job of capping the market back in late August, then again 3 weeks ago, and even last week. At the same time, the short moving average, currently at 1310, started to provide some support, though I personally did not think the support was that extensive. Eventually, prices pushed up through the short medium moving average last Friday, currently at 1331, with a middle of 3 consecutive daily bullish opening white Mariposa's. That same day, prices also punched up and closed over the recent 50% Fibonacci line at 1349. Now, the very next session, that was this past Monday, the third bullish opening white Mariposa went up to challenge the next overhead resistance, and that was the flatlining medium moving average, currently 1363. And it's been challenging ever since. We've barely had one single close over this moving average, and that was yesterday. Yet at the same time, we have seen tests higher through congestion at 1378 and new highs not seen since late August. This is obviously due to the medium moving average. It's also due to the imminent arrival of the long moving average, currently at 1395, entering the frame from above. I would also add into the mix the whole overhead band of congestion between 1378 to 1409. A band I had spoken about in earlier times, as back then it had contained the base of the earlier, late 2022 descending triangle at 1378 and the lesser Fibonacci line at 1409, both exceptional levels in the past. This is why we have the hesitation of the last 2 sessions. Now, today, we have opened over the medium moving average, and whilst we may look indecisive right now, I am beginning to wonder if this high open could be the precursor for a fresh attempt higher. It's still early yet. Chicago soybean meal. 4 weeks ago, the market broke above the highlighted in purple late July to late August bearish shift pitchfork. Now, there was no weekly key reversal up here 4 weeks ago, as we saw in soybeans. But that did not mean it was immune from the effects of what happened in soybeans. No. We saw this play out when prices punched up and closed over the upper tine of the bearish shift pitchfork, the short medium moving average, currently also 40160, the medium moving average, currently 40750, plus the 50% Fibonacci line of the October 2021 to March 2023 move of 40360. These have all become supports. Then there came a pause over the last 2 weeks as the market gathered strength around the lesser Fibonacci line at 415.5 for the next big assault on the upside, and that's the slowly declining long moving average, currently 425.40, until last Friday when prices punched up through and closed over the long moving average, which was swiftly followed by a move up over the interesting neckline of the old December 2021 to June 2022 head and shoulders top, currently 436.70. And it's highlighted in dark blue on my daily chart. Now you would think, hey, this is a pretty good move higher, and the hesitation of 2 and 3 weeks ago, well, that could be a halfway hesitation, and we may well see a move higher for this bullish halfway hesitation up to the 460 to 465 area. And you would be right. However, yesterday saw a sharp rise to the resistance evident from the July high of 451 even, with an equally sharp fall leading to an indecisive spinning top right at the top of the recent rise. Now, I'm always cautious about such indecision when seeing it close to a top or a bottom, so I'm cautious here, right now. But you would need to have a fall below the hesitation with consecutive closes below the long moving average to dent this drive higher, and consecutive closes below the medium moving average to really start thinking bearish thoughts about this market. Additionally, in the background is the fact that October was a monthly key reversal up, something not to be taken lightly. Finally, this brings me once again to a point which I raised 23 weeks ago and which I will keep raising for the rest of this year at the very least. You see, on my long-term monthly charts, as we enter the 11th month of this year, 2023 is set out to possibly be an annual key reversal. Thus, if we were to close on New Year's Eve, either above 471 even or under 399.10, then we'd be on. Anything in between and would have a lesser outside year. Right now we are looking at an annual outside year, but whilst we still have time to change that, the sands of the hourglass are rapidly emptying and time is running out. Chicago soybean oil. The late June, mid-August head and shoulders top with an extension or handle on it led to the latest key pattern here. Initially it was a descending wedge pattern which over time became a bear channel, currently 45.76 to 49.68, and which you can see highlighted in dark blue on my daily chart. This market, much as soybean meal, was not immune to the weekly key reversal ups made in soybeans itself, and tried to turn a test lower early 4 weeks ago into a break up over the upper trend line, but it was not successful, or rather, its only success was to turn the original descending wedge pattern into what you see now, a bear channel. That does not mean the upper bear channel line is not immune from being challenged, as you can see that happening all this week. However, I suspect this challenge is due to one factor, and that is immediately below the market, the somewhat surprising 38.2% Fibonacci line of the big March 2020 to April 2022 move at 48.95, which is standing immovable, at least on a closing basis, below. This cannot last, as by the end of tomorrow, the upper bear channel line will cross the 38.2% Fibonacci line, and something will have to give way. Last week I said I didn't think this 38.2% Fibonacci line looked that strong. Well, it has been much more formidable than I anticipated, and I'm very curious to see which gives way. If the Fibonacci line gives way, then we may not have that much support below until the lower bear channel line. If the upper bear channel line gives way, then we do not have that much overhead apart from the March 2013 high at 51.26. And I have my doubts of it being able to handle any strong reactionary move back up, which such a break might generate. You might have to look up at the February 2013 high at 54.15 to see some decent resistance should this happen. Finally, and this refers to an earlier statement about the larger descending wedge pattern seen at the start of this year, where I said the following some 19 weeks ago, and I've since also done so on every opportunity, and I quote, "I would consider this descending wedge pattern may, just may, have lately morphed into a possible scallop pattern," end of quote. End of quote. I will not expand much on this idea any further at this time, as it is still early on, but the recent market decline fits in with this idea, with the exception to, well, expectation actually, to eventually witness a fall down to the area of the May and June lows between 48 and 46 zone, which we have just about done. I'm now keen to keep a close eye on this idea, as any significant breakdown below the 48 to 46 area could signal the start of this move lower, and likewise the reversion back to the peak where the head and shoulders pattern exists, well, that could signal the alternate break upwards. Two things to bear in mind. Firstly, this is a really big pattern stretching from November 2022 to date, so do not expect any immediate sharp move, but rather a longer term move. Secondly, data indicates that about 3 out of 4 times the market breaks lower. That doesn't mean it will do so here, but please just be aware of that.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.